The global silver price has already collapsed, just not where you're looking. Here's the contradiction. On Western trading screens, silver still looks orderly, priced under control. But at the same time in China, physical silver has already traded above $100 an ounce, even hitting 114. That creates a gap of more than $11 against US futures prices. In a normal market, that gap should vanish instantly. It hasn't. It's expanding. That tells you something fundamental has broken. Because arbitrage only fails when the thing being traded can't actually move, or can't actually be found. If you assume markets are real because prices reflect supply, this matters to you, because this isn't about silver going up. It's about whether the number on your screen still represents something that exists. The West is quoting a paper price. The East is bidding for metal, and the metal is leaving. But here's the part nobody is saying out loud. If two prices for the same asset can coexist, then one of them is already fake. And once that realization spreads, the system doesn't correct itself. It fractures. What you're seeing here didn't appear overnight. It's the visible phase of a process that's been building quietly, then suddenly all at once. Official narratives frame this as volatility, speculation, or temporary dislocation. But that framing avoids the core issue. What's happening now only makes sense if you stop treating silver as a single global market, because it isn't behaving like one. In the West, silver is still primarily traded as a financial instrument. Contracts change hands, volume looks deep, liquidity appears endless. But in the East, silver is being treated as a physical asset with urgency attached to it. Buyers aren't debating charts, they're bidding for delivery. That difference matters more than price. It tells you who believes the system will hold and who is preparing for it not to. And it explains why the gap isn't closing. The people paying higher prices aren't doing it for profit tomorrow. They're doing it to secure something today. Notice the pattern. When confidence is high, paper dominates. When confidence weakens, possession takes over. That shift doesn't announce itself, it just shows up in behavior. So here's the question that reframes the entire story. If silver is supposedly abundant, liquid, and well supplied, why are two parts of the world suddenly treating it like a scarce asset? Because once that question lands, the next layer becomes unavoidable. Here's the claim that changes how this has to be understood. This isn't a pricing glitch, it's a loss of physical control. The clearest evidence is the price itself. In Shanghai, silver trades above $100 an ounce, with transactions reported as high as 114. At the same moment, US futures prices remain more than $11 lower. That gap has persisted. Fact, and persistence is the signal, because arbitrage only fails when physical movement fails. In a functioning system, traders would buy silver cheaply in the West, move it east, and lock in risk-free profit. That isn't happening at scale, which leaves only two possibilities. Either the metal cannot be sourced in the quantities promised, or it cannot be released without breaking something else in the system. Now notice what's missing. There's no flood of silver leaving Western vaults, no visible inventory surge calming prices in Asia, no reassurance that supply is flexible. Instead, the gap stays open. That tells you the Western price is no longer anchored to deliverable metal. This is where the story flips. When price detaches from delivery, markets don't fail loudly. They keep trading quietly, pretending settlement is optional. And once that illusion forms, the next move is always escalation. Once that detachment sets in, escalation stops being a choice. What should have been a temporary imbalance begins to harden into structure. Two prices, two realities, and a growing expectation that this is simply how things are now. Systems under stress don't break immediately. They adapt. They stretch rules. They normalize exceptions. That's exactly what's happening here. Western exchanges continue operating as if nothing fundamental has changed. Contracts trade, volumes look healthy. But beneath that surface, the assumption that physical delivery is routine starts to fade. Delays become acceptable. Cash alternatives become normal. Physical settlement quietly becomes something you're discouraged from asking for. This isn't new behavior, it's how fragile systems buy time. When pressure builds, they don't admit shortage, they manage demand, they slow exits, they make participation more expensive and access more complicated. Now watch how fast this escalates. Instead of supply rising to meet price, rules shift to restrain behavior. The market stops discovering price and starts defending structure. Stability becomes the priority, not truth. This is the moment where something subtle but dangerous happens. What was once unthinkable becomes standard practice, and that normalization sets the stage for the next move, one that makes the stress impossible to hide. Here's where actions expose what explanations try to hide. A US government institution responsible for selling physical silver abruptly stopped offering key silver products. The stated reason was administrative, a need to reassess pricing. But behavior tells you more than language ever will. Prices were moving faster than the system could adjust without locking in losses. When an official seller steps away during a price surge, it's not caution, it's constraint. At the same time, private wholesalers made a decision that only happens under stress. Instead of selling silver at posted prices, some chose to pull product entirely. In certain cases, melting became preferable to distribution. That's a direct contradiction. Publicly, silver is still available. Privately, it's being withheld. Notice what they didn't say. No one claimed supply was abundant. No one promised inventories were secure. The messaging stayed procedural, not reassuring. This is the line that changes how the entire situation looks. When institutions stop selling and private actors stop offering, the market hasn't overheated. It's fractured. Paper prices can still update, screens can still glow, but physical silver is already being treated as something too valuable to release casually. And once that mindset spreads, the next phase accelerates faster than anyone expects. Now the pressure becomes visible to everyone. Retail demand doesn't usually break systems. It reacts to them, but this time it collided with supply just as supply was pulling back. Large retailers began imposing strict limits on silver purchases. One transaction per customer, tight caps per day, not as a marketing move, as a containment measure. Specialty dealers followed quickly, warnings replaced availability, shipping delays stretched, back orders multiplied, premiums widened, and something more important shifted beneath the surface. Buyers stopped behaving like traders. They started behaving like accumulators. This is where the tempo changes. When people stop waiting for better prices and start clearing inventory, velocity collapses. Metal disappears into private hands, secondary supply dries up, and no amount of paper volume can substitute for that loss. What happens if this continues? Futures markets can keep trading without delivering a single ounce. Retail channels can ration without ever using the word shortage. But once enough people decide that possession matters more than price, the system loses its pressure release valve. And when that valve locks, the next response doesn't come from consumers. It comes from the exchanges. Now pull back and look at the mechanism that allows this to keep happening. Modern markets aren't built on stockpiles, they're built on leverage. Paper claims expand because they're efficient, fast, and profitable, as long as too many people don't ask for the same thing at once. Delivery exists, but it's quietly discouraged. Cash settlement, delays, substitutions, all legal, all normalized. Here's the unsettling part. The system doesn't need to reflect reality. It only needs to manage perception. Prices update instantly. Trades clear smoothly. The performance continues. And as long as that performance holds, most participants never test the edge. Physical stress breaks that spell. It exposes the incentive gap. Those who control pricing benefit from calm. Those who need the asset benefit from possession. When those incentives diverge, the rules start bending, not to reveal the truth, but to preserve order. This is why the response isn't transparency, it's management. contain volatility, raise costs, slow exits, redirect demand, because once enough people understand that paper is a promise and metal is final, the system can't scale honesty fast enough to keep up, and that realization is spreading faster than the rules can adapt. From here, the future stops being linear. There are two paths forming, and neither requires an official announcement. One path looks orderly on the surface. Paper markets continue functioning. Prices move but within boundaries. Rules are adjusted quietly. Settlement terms soften. Cash becomes an acceptable substitute for delivery. In that version, the system survives, but only by redefining what access really means. The other path is less controlled. Physical demand keeps pulling metal out faster than confidence can replace it. Industrial buyers start bypassing exchanges. Retail supply thins further. At some point, paper prices stop leading and start reacting, not because anyone admits failure, but because behavior forces the issue. Both paths rely on momentum, not decisions, small delays that don't reverse, premiums that don't compress, exceptions that quietly become permanent. And here's the key detail. The next move won't be made by traders looking for profit. It will be made by whoever needs silver the most and can't afford to wait, which means the question isn't which outcome happens. It's how far along we already are. There's one insight that ties all of this together. This isn't a story about silver becoming expensive. It's a story about credibility evaporating. When a system runs on claims instead of custody, the moment delivery is questioned, value has to be rediscovered somewhere else. And that process is never smooth. Two prices for the same metal aren't a glitch. They're a verdict. They tell you the market has already split between what can be promised and what can actually be obtained. Screens can quote stability. Rules can enforce order. But physical metal only moves when someone is willing to part with it, and that willingness is disappearing. What comes next won't be decided by headlines or official reassurances. It will be decided by who holds real assets when paper finally has to reconcile with reality. Silver isn't the end of this story, it's the signal. And in the next layer, that same fracture starts showing up in places most people still assume are untouchable. That's why this channel exists.